Okay, so you want to own a bank? Put your name on the building, your logo on the cards, and collect interest every time a family makes a mortgage payment or a business repays a loan. Local businesses send payroll through your system every Friday. Families leave savings in your accounts. Thousands of customers trust your bank with money that can support even more loans and investments. From the outside, it looks almost unfair. People bring you cash, borrowers pay you interest. You keep the difference. Then, one morning, a customer opens the app and presses transfer. That single button is the entire business hiding in plain sight. Because the balance on that screen is not your money. It is money the bank owes. The loan producing interest for the next 20 years is valuable, but it cannot always be turned back into cash this afternoon. And the part you actually own is the thin layer between a mountain of assets and a much larger mountain of promises. That thin layer can make you rich. It can also disappear before lunch. In March of 2023, customers at one American bank requested roughly $42 billion in withdrawals in a single day. Another roughly $100 billion was waiting to leave the next morning. The bank had assets, it had customers, it had securities backed by the government, it had been growing. It still could not open normally the next day. To understand how that happens, you first have to understand what you are actually buying when you buy a bank. Because it is not the building, it is not the vault, and it is definitely not every dollar inside the accounts. Start with the price. In a proposed merger announced in 2025, Pacific Premier was described as having roughly $18 billion in assets. The implied value of the equity transaction was roughly $2 billion. $18 billion of assets, about $2 billion to acquire the shareholder claim. That can look like an extraordinary bargain until you turn the balance sheet around. The buyer was not receiving $18 billion free and clear. The bank also owed billions to depositors and other creditors. The buyer was purchasing the portion left after those obligations, along with the right to control the institution if regulators approve the deal. And most people who say they own part of a bank own something narrower than that. They buy shares in a bank holding company. Those shares give them a small economic claim and voting rights, not the ability to walk into a branch, change a loan decision, or direct what happens to customer deposits. Buying stock and taking control of the institution are completely different levels of ownership. That distinction matters because banks are measured with numbers that sound like ownership and are not. Total assets tell you how large the institution is. They do not tell you how much belongs to the shareholders. Deposits tell you how much customer money sits inside the bank. They do not tell you how much revenue the bank earned. A growing loan book tells you the bank is doing more business. It does not tell you whether that business is good. A bank can be huge and still have a surprisingly small owner cushion. And you cannot simply buy that cushion the way you would buy a hotel or a chain of stores. A controlling acquisition normally requires regulatory approval. The buyer's money, management, competitive impact, community obligations, future plan, and financial crime controls can all be examined. You are not only purchasing a company, you are asking for permission to control an institution whose failure can affect customers who never agreed to take shareholder risk. So perhaps you build one instead. You find a storefront, hire a few bankers, install a vault, open the doors. Except none of those things makes it a bank. A new bank needs a charter and federal deposit insurance. It needs qualified directors and managers, a working compliance system, cybersecurity, fraud controls, a way to process payments, a way to survive a technology outage, and a plan for producing cash when customers ask for it. The Federal Deposit Insurance Corporation expects organizers to submit a business plan covering the first 3 years. It also expects enough initial capital to maintain a Tier 1 leverage ratio of at least 8% throughout that period. And the organizers are not supposed to build the plan around rescuing themselves later. They should not assume another capital raise will arrive when the first one runs low, or that they can begin paying themselves dividends before the institution has proved it can operate safely. There is no single startup price for a bank. A small traditional institution and a national digital bank are not the same project. But the capital can become enormous. In April of 2026, the proposed online Mercury Bank received preliminary conditional approval requiring at least $300 million in paid-in capital after organizational and opening expenses, along with a Tier 1 leverage ratio of at least 10% during its first 3 years. That is not the normal price tag for every new bank. It is proof of what the entry cost really is. You are not buying counters, offices, and a metal door. You are funding the mistakes the bank has not made yet. Now, suppose the approvals arrive and the institution opens. A small business deposits its payroll money. A family puts savings into an account. A customer receives a loan to buy a home. The bank's app shows all three of them neat numbers. But those numbers sit in very different places. The loan is an asset because the borrower owes the bank. The deposit is a liability because the bank owes the customer. The owner's equity is what remains after the liabilities are subtracted from the assets. Across all institutions insured by the Federal Deposit Insurance Corporation, The first quarter of 2026 ended with roughly $26.1 trillion in assets, roughly $20.5 trillion in deposits, and roughly $2.6 trillion in total equity capital. Picture those numbers as a building. The assets fill nearly every floor. Deposits and other obligations support most of the weight. The owners stand on a much thinner level at the bottom. Why would anyone want to own the thinnest floor? Because every loan payment, every security coupon, and every financing relationship can send income down toward that layer. The basic engine is net interest income. The bank earns interest on loans and securities. It pays interest on deposits and other funding. What remains between those two flows is the spread. In the first quarter of 2026, the annualized yield on earning assets across insured banks was roughly 5.33%. The cost of funding those assets was roughly 2.02%. Net interest margin was roughly 3.31%. That is not a spectacular markup. It is a narrow margin applied to an enormous surface. Take a bank with $10 billion of earning assets. The owner does not need every loan to become a home run. The bank needs a vast number of ordinary payments to arrive on time, while the cost of keeping deposits and other funding remains below what the assets earn. The bank may also earn money outside the basic spread. A business can pay for transaction services, customers can generate card and account fees. Some institutions earn from wealth management, loan sales, or other financial services. Those revenues can matter, but they do not remove the central problem. Every service still depends on customers trusting the institution enough to keep using it. This is where the thin owner layer becomes attractive. Across the industry in that same quarter, return on assets was roughly 1.26%. Return on equity was roughly 12.4%. A little more than 1% earned across the whole balance sheet became more than 12% against the shareholder layer. That is leverage. The bank uses a relatively small amount of owner capital beneath a much larger pool of assets funded mostly by obligations. When the machine works, the owner receives a much larger return than the raw asset margin suggests. Now reverse it. A bank does not have to lose half its assets to destroy half its equity. A few weak loans, a badly timed sale, or a decline in asset values can cut through a thin capital layer surprisingly fast. Regulatory capital exists to absorb that damage before protected depositors do. But that is not the same as preventing damage. Capital is not the wall around the risk. Capital is what the risk hits first. And the spread has to pay a long list of bills before shareholders see what remains. Imagine the bank at 2 in the morning. The branch is dark, but the business is still running. Servers are moving payments. Fraud systems are stopping suspicious transfers. A customer has lost a card. A business is preparing payroll. A security team is watching for an account takeover. Somewhere else, an examiner is waiting for records. A lawyer is reviewing a complaint, and a loan officer is deciding whether a borrower can repay. None of that stops because the lobby closed. In the first quarter of 2026, insured banks reported roughly $282.7 billion in net operating revenue. Non-interest expense was roughly $159.8 billion. The expense is not one dramatic bill. It is the permanent machinery of being trusted with money. Employees, technology, branches, payment systems, fraud prevention, cybersecurity, legal work, audits, compliance, data processing, insurance assessments, and the cost of fixing small failures before they become public ones. Then a borrower misses a payment. The loan may have looked excellent when it was approved. The business had customers. The property had value. The borrower had income. But businesses close, jobs disappear, collateral falls in price, and a loan that produced interest for years can still return less principal than the bank expected. The bank records provisions for expected credit losses because the interest rate printed on the loan agreement is not the same thing as the final return. On a lightly leveraged business, a bad account is painful. On a bank balance sheet, a small decline across a large loan portfolio can reach the owners very quickly. But credit is only one way the balance sheet turns against you. The funding can move too. A customer walks into a branch and sees a savings account. The owner sees a source of funding. Those are two views of the same promise. Some deposits cost very little in direct interest. Others become expensive when market rates rise and customers begin comparing offers. A business may keep money at a bank because payroll, payments, fraud controls, and credit lines are already connected there. Another customer may leave the moment a competing app offers a slightly better return. The balances can be identical. Their value to the bank is not. Now imagine two banks reporting the same growth. Both added billions in deposits. Both expanded their loan books. Both look stronger than they did a year earlier. The first bank added thousands of households and businesses across different industries. The relationships grew slowly. The money moves in different directions at different times. The second bank added a smaller number of very large customers from the same connected market. They know one another. They read the same news. Their businesses rise and fall with the same cycle. On a quarterly chart, both banks grew. Under pressure, they are completely different institutions. This is why rapid growth can be a warning. More deposits can mean more stable funding. They can also mean one concentrated crowd standing close to the same exit. More loans can mean more income. They can also mean underwriting, staffing, technology, and controls are being asked to grow faster than they can safely grow. The number rises first. The weakness appears later. And sometimes, the weakness is hiding inside an asset everyone assumed was safe. Suppose your bank buys a long-term government-backed security when interest rates are low. The security keeps making the payments it promised. Then market rates rise. New securities begin paying more. An investor will not pay full price for your older low-rate security when a new one offers a better return, so the market value of the old security falls. Nothing has defaulted. The asset still lost value. If you can hold it until maturity, the lower market price may never become a cash loss. But if customers suddenly ask for money and you need to sell that security today, the market gets the final word. At the end of the first quarter of 2026, insured banks reported roughly $325.1 billion in unrealized losses on securities. Roughly $214.5 billion of that sat in held-to-maturity portfolios. Those figures did not mean every bank had secretly lost that amount in cash. They did not mean all of those institutions were insolvent. They meant the market value of many securities had fallen below their reported book value, and the difference mattered most to any bank that could no longer wait. Now return to the customer pressing transfer. A traditional bank can own excellent loans, valuable securities, a respected brand, and a long history. None of those assets answers the customer's immediate question. Can I have my money now? This is the hidden franchise at the center of the business. For a traditional commercial bank, one of the most valuable things it can build is a stable group of depositors who use the institution every day and do not all behave the same way. A household keeps a checking account because bills are attached to it. A business keeps payroll money there because changing banks would interrupt operations. A customer uses the same institution for savings, payments, and credit because the relationship works. The deposits remain liabilities. The bank still owes every dollar. But stable deposits can fund the asset side at a manageable cost for years. That is why acquirers care about core deposits. A Federal Deposit Insurance Corporation study of community bank acquisitions found that acquired banks tended to have higher core deposit to asset ratios than comparable institutions. The value was not simply the cash sitting in the accounts, it was the behavior around the cash, the relationships, routines, and confidence that made the funding more durable. The most valuable part of the bank may sit on the side of the balance sheet labeled money owed. And the whole arrangement works because customers believe they can leave. That sounds backward. It is the point. The bank earns by placing funding into loans and securities that may repay over years. The customer may ask for the balance this afternoon. Under normal conditions, the bank handles that difference with cash, incoming payments, liquid assets, borrowing capacity, and careful planning. Then normal conditions end. Silicon Valley Bank had spent years building deep relationships with technology companies, venture-backed firms, founders, and investors. That position helped the bank grow quickly. It also meant many customers were connected to the same financial ecosystem, exposed to the same slowdown, and watching the same information. At the end of 2022, roughly 94% of the deposits at Silicon Valley Bank Financial Group were uninsured. That did not mean the money had already left. It meant many customers held balances above the standard insurance limit of $250,000 per depositor, per insured bank, for each ownership category. They had more at risk, more reason to monitor the bank, and the ability to move large amounts quickly. On the asset side, the bank had invested heavily in long-dated government and agency mortgage-backed securities. The held-to-maturity portfolio had a weighted average duration of roughly 6.2 years. The securities were not failing to make payments. The timing was failing. Interest rates rose, which reduced the market value of older low-rate securities. Venture funding slowed, which meant many customers were spending their deposits instead of replacing them with new investment money. The bank needed liquidity at the same time its long-term assets had become more expensive to sell. On March 8th of 2023, the parent company announced that it had sold available for sale securities and taken a loss of roughly $1.8 billion. It also announced a plan to raise roughly $2 billion in capital. The announcement was meant to show a solution. Customers saw the problem. Finance teams began talking. Investors began warning companies. Executives opened online banking screens. These were not thousands of people waiting for one teller. They were connected organizations capable of moving millions with a few instructions. On March 9th, customers requested roughly $42 billion in withdrawals. Nearly one quarter of the bank's deposits requested in one day. For the following morning, roughly $100 billion more was waiting to leave. The loans had not all defaulted. The securities had not all stopped paying. The branches had not burned down. The bank ran out of time. It could not produce the required cash and was placed into receivership on March 10th. That failure is often reduced to one neat explanation. Rates rose, a bond portfolio lost value, social media caused a run, management made mistakes, regulators missed the danger. Each statement captures part of the story and misses the system. The official reviews described a chain: rapid growth, concentrated customers, an unusually high share of uninsured deposits, long duration securities, weak interest rate and liquidity controls, inadequate governance, poor communication, and supervisory failures that did not force correction soon enough. The growth created earnings and concentration. The securities created income and duration risk. The capital announcement offered repair and signaled fear. One piece did not fail by itself. Several pieces stopped supporting one another at the same time. Then the bank closed, and the difference between being a customer and being an owner became impossible to miss. Federal authorities used a systemic risk exception to protect all Silicon Valley Bank depositors, including balances above the normal insurance limit. Customers retained access to their money through a bridge institution. The Federal Deposit Insurance Corporation said the related costs would be recovered through a special assessment on banks. The shareholders were not protected. Certain unsecured debt holders were not protected. Senior management was removed. A customer could open the app and find the balance still available. A shareholder could open a brokerage account and find that ownership had not been rescued with it. The business continued serving depositors after the former owners had lost the bank. That outcome was extraordinary, and it should not be treated as a guarantee that every uninsured depositor in every future failure will be protected. But it proves the ownership structure with brutal clarity. Depositors are creditors. Shareholders own the residual claim. The residual claim receives the upside only because it is designed to absorb the loss. So does owning a bank work? The strong version does. You buy or build it at a price that leaves room for ordinary years, not only perfect ones. The deposit base comes from many households and businesses rather than one tightly connected group. Customers stay because the bank is useful, not merely because it is paying the highest rate this month. Loans are made to people and companies capable of repaying them. Long-term assets are matched against funding that can survive long enough to support them. Capital, cash, borrowing capacity, staff, technology, and controls grow before the risk does. In that version, the economics are powerful. A narrow spread across a large balance sheet can produce durable earnings. A stable deposit franchise can keep the cost of funding manageable. A modest return on assets can become an attractive return on equity without requiring spectacular bets. The weak version can look almost identical from the sidewalk. The same polished app, the same marble lobby, the same total assets, the same growth announcement. Inside, the owner is watching a different bank. A small group of large customers supplies too much of the funding. Deposit rates keep rising because customers have no reason to stay otherwise. New loans are arriving faster than the risk team can study them. The securities portfolio earns a little more only because the money is locked away for much longer. Management sees the growth chart and assumes confidence has become permanent. The balance sheet looks profitable as long as nobody demands that it move quickly. And no, the answer is not to leave every dollar in cash. A bank that takes no risk earns too little to justify its capital and operating cost. A bank that takes risk without respecting time may not survive long enough to collect the return. That tension is not a side effect of banking. It is banking. You began with your name on the building and other people's money working behind the glass, but the building is only where the promise is sold. The app is where the promise is tested. What you really own is the responsibility to make one ordinary moment remain ordinary. A customer presses transfer, and the money arrives. The loans create the income, the equity takes the damage. The bank survives by making that button boring.